Jim Bird and Justin Struble from Safe Harbor Financial Services are here to talk about the stock market this morning. So we're going to be talking about investing advice, and I know last week the stock markets took a big tumble, so a lot of people, investors, worried about their money. So in your opinion, is the market bubble going to burst?
Chairs, I think yes, it is, and I base it on several factors and some of the advice from the leading economists of the country. One of the problems that we've got is this delayed rebalancing of the budget, and the fact that the bankers are going to stop their economic stimulus program that they've been creating from easy money that the government's been giving them. You see, Ben Bernanke, the federal chairman, he knows that any way for us to have a robust economy, we got to get excessive debt in control. Okay, and so what they've done, they've printed this money to stimulate the economy. In fact, it's increased 6 times in the last 6 years. So we can't keep doing that and to do it, and it's actually failed because they thought it would stimulate the economy. They thought that or inflation would grow. We'd have hyperinflation. Well, neither of these have happened. And every time Bernanke steps on the gas, the economy gets worse. And one of the reasons for this is what we call circulation of money. In a normal economy, like pre-2007, a dollar would circulate 8 times in the economy at a normal rate. Well, right now, it's an all-time low of 3.1 times.
Wow.
So what that means is the money's not circulating in the economy.
So where is the money? Where did it go?
Well, that's a good question. See, the banks were supposed to lend money out to people and have easy loans, and that stimulated the economy. But what happened? The bankers invested in the stock market, which has caused this all-time high in the stock market. And that's about to end because when they cut off the easy money, then there's no more money to go out in the stock market. And the stock market's going to crash, which is going to bring everything else down.
It's going to affect everyone, not just investors.
That's correct.
Okay, so who's going to feel the biggest impact as far as the stock market if that were to happen?
In the economy, obviously real estate gets hit the most because interest rates go up. People can't get the low rates that they're used to right now. In the stock market, bonds are going to get hit the most. We see people every day, and we'll analyze a new portfolio. And if interest rates go up 1%, we'll regularly show people 4 or 5% loss on their bond portfolio. So just a minor change can, just from interest rate risk, hurts them severely because we have so low interest rates. It's that big of a factor now.
So what should we do? I mean, does this mean we all need to keep a closer eye on interest rates across the board?
The Feds, they're controlling them right now. That's the driver. If the Feds stop the funding, then you're going to see interest rates go up and bond prices plummet.
But is there anything we can do about it as consumers?
Stay out of bonds. Bonds are your risk. Not that all bonds are bad, but you have to be aware of that risk. Short term is better, but if you're in a traditional bond, it used to be the safe haven for you go from stocks to bonds to be safer. Right now, they've got as much volatility as stocks do.
So basically, as you've got to watch it, and when the market goes, it's going to go quickly, and some people won't have enough time to react. So you just got to watch that, and you've got to look at some safer vehicles and put your money if that bothers you.
And really protect yourself.
Yes.
Oh, my goodness gracious. So a lot to think about there. So if you need any more investment advice, you can get that when you call Safe Harbor Financial, and we'll have their phone number on our Studio 10 page on fox10tv.com. Thank you, gentlemen.
Thank you.
Thank you.